Everyone, David Moore, IRA Advantage, and I'm frustrated this morning. A great place, but can't get, for some reason, technology's killing me today. So we are late. I've got a lot to get through. I'm going to do it, and hopefully you can see what I've got on the screen right now. And then we'll be sending the slide deck out afterwards with CE certificates. If you need CE for this class, please reach out to cmore@iraadvantage.net, cmore@iraadvantage.net, or cmore@1031exchange.com. So from uncertainty to control, real estate, gold, and self-directed IRAs. And just like start off saying that we at the Advantage family, we've got an IRA Advantage handle self-directed retirement accounts, whether it's 401k plans, IRAs, rollover business startups. We're going to talk about all of those today, or 1031 exchanges through sister company, Equity Advantage, 1031exchange.com. So we don't sell investments. We don't give investment advice. We just sort of listen to where you are today and where you want to be in 2, 5, and 10. And we're going to help get you there. So retirement accounts, one of those things where my brother Tom and I started Equity Advantage in 1991 to handle tax-deferred exchanges. And during the ensuing years, people just kept coming to us saying, "Hey, we want to be able to use qualified money to go buy property and make loans, buy notes, that type of stuff." So we started learning that whole world. And the frustrating thing was I go to a class on how to make an investment. All I would learn is how to make the investment that company is trying to sell me. So a truly self-directed account is going to allow you to buy literally anything the law allows. It's wide open for you, and that's a great thing. The downside of it is you can literally do what you want when you want. So if you want to screw it up, you have the ability to do that. So a truly self-directed account is literally going to give you the ability to buy anything the law allows. So if you were able to see my slide deck right now, you'd see 2 menus. And one's a happy hour menu for my buddy of mine had run a bunch of Eddie V's, opened them up through the years. And so I found an Eddie V happy hour menu, which is this much abbreviated. It looks very, very good, let's say. But it doesn't have the full Eddie V menu with shellfish, appetizers, second course, all the yummy stuff, the prime seafoods and the hand-cut steaks, all that. So if you're going out to dinner, do you want to just be stuck with the happy hour menu or the full menu? And that's sort of what we're looking at when we look at a truly self-directed retirement account. Your IRA today, you may have one. If I was sitting in a room with you guys and we had 40 people in the room and I asked, okay, who in the room's got a self-directed IRA? Maybe half of you put your hand up. And when I start asking who those custodians are, if you're saying one of the big Wall Street firms, I'm going to tell you, you don't have a self-directed account. You've got what they call a self-directed account, but it's going to allow you to buy what they want to sell you. It's not going to allow you to buy anything the law allows. So when we're talking in the context of a truly self-directed account, you name it, you can probably invest in it. We're going to talk about the very few restrictions in a minute, but it's really wide open for you. So we like to say it's your money, do what you want with it. And the other thing I'll say is think about situation where you've got specific knowledge of something. If you're a lender, for example, and you want to make loans with your retirement account, you can do that. I would hope that you as a professional in that space would have some additional information and a slight advantage there. But when we look at these things, you think about a retirement account, and I think a lot of times it's sort of lost that that's your money. You're sort of stuck with it in Wall Street until probably 59 and a half. If you take money out before you're 59 and a half, you're going to have a penalty there. But after 59 and a half, you can take money and roll it in different things, or you can take it out without a penalty. You're going to pay normal income tax on a distribution, but you can do what you want with that money. If we're looking at funding a self-directed account, we have to understand when and how you can do that. And rollover, so people that are in between jobs, that's an opportunity to roll your previous employer 401k plan into either a self-directed IRA, or 9 times out of 10, people just roll it into the new employer plan. And I would ask you, why do you do that? Because now you're just saddled with that new firm's menu of investment options, instead of taking it out, putting it in an IRA, and literally doing what you want to do. Through the years, I've actually had business owners step away from their business for a period of time to get access to their money to self-direct their accounts. In a sort of a tough situation once, we had somebody quit a job with one company, started the self-directed process, took the job with a new company, and before the process was completed, and that person didn't understand that the new company had the same parent as the old company, so the plans were sort of one and the same, and we could no longer, since he took the new job too quick, we couldn't get access to that money. So if you're looking at a 1031, we always think about the situation where time is not your friend, and you want to stop. Do not go forward if you're not sure you want to do something in a certain way, or you're not sure it's the right thing. And I'm going to tell you, do the same thing with the retirement accounts. If you're in between jobs and you're contemplating, okay, now I've got access to that previous employer money, what do I want to do with that? Do I want to put it in the new company plan, or do I want to have access to do what I want to do when I want to do it? And I'm going to say that's probably where you want to go with the stuff. But it's up to you. So today we're going to talk about a variety of these accounts, what you can do with these different accounts, accessing them, when to do that stuff. So hopefully you're going to get some good information out. I apologize for some reason all this technology is not working today, and we will get you the slide deck. This thing will make good on it. And like I said, if you need, should have their slides by now. You should have your slides via email by now, from what I am just being told. So hopefully, if you've got an email, you can open it up, take a look at that way. We are on the 5th slide, if you're on that, and it's a self-directed retirement account. And I just want to say, self-directed is not a legally defined term. It's just a term that describes an account that allows you to go do what you want to do. And a truly self-directed account is going to allow you to do that. And like I said, on the downside, a Wall Street account, you can have your charge your financial advisor to make all your investment decisions on that. You may be able to make a poor investment decision, but you're not going to be able to create a prohibited transaction. If we're looking at a truly self-directed account, you've got, let's say, what we call the power of the pen to go buy and sell things at will when you want to. And if you want to create a prohibited transaction, you can do that. So the other thing I see happen is people will fund a self-directed account and they won't make any investments, because it's easy to get mad at your financial advisor for maybe some poor investment decision, but now it's all on you. So I've seen people put these accounts together, get them funded, they sit there, and a year later they haven't made any investments. I ask, well, gee, why haven't you done that? It's like, well, this is tough. Well, yeah, it is. It's making sense of your investments can be difficult, but truly self-directed is wide open. Literally invest in what you want, with only a couple exceptions. So options, opportunities, slide 6, we're talking about change of a career, your rollover opportunity. That's a situation where, as I said, at 59.5, you can sort of do what you want with your retirement account. Even if it's a current employer plan, you can take that money and go do some other things with it. You can move it in a self-directed IRA and all. But if you're happily employed under 59.5, current employer plan, you're probably stuck with stuff the way it is. And most employer plans are not going to allow you to buy things off Wall Street, just because the liability, I guess, is a primary concern. And a lot of times the administrators are not wanting to deal with things that they can't easily deal with. So when we start looking at notes or making private placement investments or real estate, they typically are not going to offer those things in a typical 401k plan. So when we look at this, I've mentioned a few different things. When we talk about self-directed accounts, we've got a variety, a little menu of options. We've got a basic self-directed IRA. Basic self-directed IRA means we're just going to create a custodial account with a trust company that allows self-directed investments. And those are great because they're very inexpensive, put together. And by the way, this is never an all or nothing situation, but you can move that money in that new account and go do what you want, with that within some reason. When you've got a basic account, every investment has to be submitted to the trust company, approved by the trust company before the investment's going to be made. So it takes some time. And if you're, let's say, writing a real estate offer, you need to include something in that purchase sale agreement stating specifically that the offer would be subject to the custodian's or trust company's approval of the investment. The other thing that can be tough is when you're looking at a basic account, the owner, let's say it's a piece of property, the owner of that property would be the trust company, CFBO, custodian for benefit of your IRA, whatever that might be. So who has the power of the pen to write the deal? I mean, you're writing an offer between the seller and the trust company for benefit of your IRA. You don't have the power of the pen to sign for that trust company. And even though the purchase sale agreements are signable, you should not simply assign the purchase sale agreement from you over to your retirement account. That could constitute a prohibited transaction, because you took the property off the market before that retirement account actually was in place. So there was a benefit to that retirement account. Therefore, it could be considered a prohibited transaction. Definitely don't want to be putting personal earnest money into a deal and having that coming back. But a basic self-directed IRA works great for passive, non-time sensitive investments, very inexpensive put together, and they work just fine. Little complicated to make the investment because you get the trust company involved. There's paperwork that has to be handled there. A checkbook advantage self-directed IRA. So we have equity advantage, IRA advantage. We have our checkbook advantage self-directed IRA. And that gives you the power of the checkbook or a IRA LLC. So in that situation, what we're doing is we're still creating that basic custodial account. We're creating a new IRA-specific limited liability company. The trust company is making the investment in that LLC that you're the manager of. So the member of the LLC is the trust company. The manager is you. You have a bank account in the LLC's name and EIN. You have the only investment decision that the trust company is involved with is the funding of that IRA LLC. And as soon as they've made that investment, your interaction with the trust company is reduced to annual valuations of all cash and assets you've got. That's really it. You're not asking them for anything to make an investment. That same transaction I just talked about with the offer between the seller and the trust company for benefit of your IRA and getting somebody to sign. Now the offer is between the seller and the limited liability company that you're the manager of. So it's a very simple deal because you're just going to be signing everything as a manager for the LLC, and you need earnest money. You just place the earnest money. So it's a wonderful deal, and it allows you to actually manage assets, because imagine a rental house, for example, and if the trust company is the owner, you better have professional management. There's no way for you to manage that thing. Where if you've got a checkbook advantage IRA, that checkbook IRA LLC, now you've got just that checking account in the LLC's name and EIN. You as manager of the LLC, any expense you're going to pay write the check for, and any income is going to go into that LLC account. So all the ins and outs are all in and out of that limited liability company. And it works very, very easily, whether it's a purchase or whether it's paying for costs or dealing with tenants, whatever it might be. That checkbook advantage really makes a big difference. A solo 401k I really like. So for real estate, if you're a real estate broker, you're probably self-employed without employees, or maybe a spouse works with you. That solo 401k is going to be the way to go for you. Anybody who's self-employed without employees, that solo 401k is a wonderful vehicle. It works just like the checkbook IRA, but you don't have to have the LLC. If you want an additional LLC on top of the solo 401k plan, fine. But when we look at that solo 401k, you're really just going to have a bank account in the 401k plan's name and EIN. You are the trustee of the plan. So to make the investments, they work just like that checkbook IRA. And then finally, of those sort of four options that we offer people, we've got a rollover business startup, or ROBS. Now that would be used for somebody that wants to, let's say, go out and buy a business and work for that business using their retirement account. So those things, we've done everything from gold, silver, palladium mines, car dealerships. We did a title escrow company once. We've done hotels, motels, lots of, let's say, real estate investment companies, a whole variety of things. But we can literally create a new business that could be, your dream business that you're working for, and that can be funded using your retirement account. So the roller business startup is a combination of a 401k plan and a C corporation, where that checkbook IRA is a combination of an IRA and a limited liability company. But those are sort of the menu of four different investment vehicles that you have to choose from when you're looking at self-directed accounts. So can my retirement account be self-directed? Any IRA can be self-directed. So it's very easy when we're talking about IRAs. 401k plans, we've got different situations as we've been talking about. Previous employer plan, we can self-direct. Current employer plan, if you're under 59 and a half, we cannot self-direct. As soon as you hit 59 and a half, we can take that money and then self-direct that account, that 401k plan, even if it's current employer plan. I've literally had business owners, like I said earlier, step away from their company for a period of time to get access to their money when they want to make self-directed investments. You just can't take it out, even if you're the business owner. So, be aware that really, as far as self-directing these accounts, any IRA can be self-directed. 401k plans depends upon your age and whether it's a current employer plan or previous employer plan. So these things are not, we're on slide 9. It says, is it difficult to create a self-directed retirement account? No, it's not. I mean, if we're looking at a basic account, you can go online and if you type in self-directed, truly, or self-directed IRA, you might come across maybe Forge Trust or IRA Resources, companies like that. SunWest Trust. There's a whole variety of them out there, and they're going to have online applications. So you can literally go do it from home online if you want. It's pretty easy and very inexpensive to put one of those things together. People do contact us to put the basic accounts together just because it does get confusing for people. And so we'll put basic accounts together too for people. But typically that's something you don't need us for. You will need us for the IRA LLC, because even though you might say, well, gee, I put LLCs together for my real estate all the time or for this or that, that operating agreement is not going to work with a trust company with an IRA. So you got to understand that when we're talking about an IRA LLC, it's a totally different animal than a basic. And if you've been on my classes before, you've heard me talk about a situation where I had a client. I knew, she's a very, very successful business person, and she doesn't have a lot of patience with stuff. And we said, hey, you can do what you're talking about doing with a basic account, but you're probably not going to like it. And you can save yourself some money with that. So we did the basic account. And then she came back later to us because she had changed her mind wanting the checkbook IRA LLC, and she just reached out to her lawyer and said, hey, put this LLC together for me. And $10,000 later, the LLC was not usable, and so they put up the white flag, came back to us and said, hey, put it together for us. So it's got to be a specific operating agreement. The trust companies need to be familiar with it. They're gonna go back and forth until they see what they want to see in that operating agreement. But anyway, that checkbook IRA is just that additional layer. So the basic account is required with the checkbook IRA. The only difference is we're sticking that IRA specific limited liability company between that trust company and the ultimate investment. So it's an additional step, but it really makes investing easy going forward. 401k plans, really we can fund a 401k plan with traditional IRA money, whether it's a basic or a SEP or a simple, it doesn't really matter. We cannot fund a 401k plan with Roth IRA money, nor can we fund it with a beneficiary IRA, one that's been inherited. So those two are restrictions if we're talking about 401k plans. They are not when we're talking about IRAs. Now, it might mean that you could have let's say a checkbook IRA or IRA LLC that it doesn't just have one, let's say, traditional IRA as its member. It could have traditional Roth money as its members. It could have traditional Roth. It could have you and your spouse, your personal money and plan money. All those things can be combined into one investment vehicle. It's just that when we combine disqualified parties into a common entity, we've got more restrictions on setup, and we just have to be more careful with everything going forward. That's a whole class in and of itself, is when we're creating multi-member checkbook IRAs with both qualified and non-qualified money with disqualified parties as members. It just sort of snowballs, but anything's possible, like my wife likes to say. Common objections. So when you talk to your tax people about this, or your lawyer about this, or maybe your financial advisor, they're often going to say, well, gee, why would you take your IRA or 401k plan and go buy real estate with it? Because you're going to lose long-term capital gains tax treatment. Well, that's true, but there's not an investment you're going to make with a retirement account that's going to give you those things. So loss of long-term capital gains tax rates, yes, that's true. If you pull money out of your pocket, if you could make the investment only with money out of your pocket or only with the qualified money, you're better off doing it with money out of your pocket, because you don't have to worry about prohibited transactions. You don't have to worry about, we'll talk about non-recourse debt in a while. You don't have to deal with a trust company or anything else. And at the end of the day, you're looking at long-term capital gains tax consequences on a disposition, or handle it via 1031 and kick the ball down the road. And that's a wonderful thing. So if we're talking about any investment your IRA owns or 401k plan owns, everything in that account has to come out at some point. And when it comes out, you're paying normal income tax. So yes, the number one objection by Wall Street is, hey, why would you buy the real estate? Because with the IRA 401k, because you lose long-term capital gains tax treatments. Totally pointless statement. Nothing you buy with a retirement account is going to give you that. So it's really it means nothing. The second one is cannot be leveraged. An IRA owned or 401k owned asset cannot be leveraged. Wrong. Can be, it's just got to be non-recourse debt. So you're not going to find that kind of money at your friendly banker. You're going to need to talk to a bank that specializes in non-recourse IRA 401k compliant debt. You could take a look at myiralender.com or iralending.com. North American Savings Bank is a big bank in that space, and they'll do all kinds of properties. They want you to have some experience. You're typically looking at maybe a little bit more expensive money, lower loan to value, but that's why they are there. And one other sort of comment I have on leveraged investments with IRAs: any income or gain attributable to other people's money, i.e. debt, would trigger some tax exposure, even with a Roth IRA. So with IRAs, you've got tax on leverage. 401k plans, you don't. That's a big difference between those two things. What about RMDs, required minimum distributions? Well, what happens? You buy a piece of property, or you make a loan to somebody, and now that money's all tied up and you have to take an RMD. What do you do if the money's not there? Well, you can take an in-kind distribution. So the in-kind distribution is what a lot of our clients do, because they'll say, well, gee, I want to take my money, go buy a place at the beach, retire into someday. They can do that. They just can't use the property, nor could any other disqualified party use the property until it's been taken fully out as a distribution. And so what happens is people will take a property out as a distribution, or they'll take pieces of the property out as distributions, or they'll assign if the property is owned by a limited liability company, you can just simply assign a membership interest in that entity as a distribution. And by taking a minority interest distribution, not only is it not a problem, so I'm going to say this, not only is this RMD issue that Wall Street likes to pick up not a problem, but it provides a real good opportunity, because in Wall Street world, typically you're looking at cash distributions. In the self-directed world, you can take in-kind distributions. If you're taking a minority interest distribution of something, it might be possible to discount that distribution by up to 40%. So not only is this not a problem, but it provides a tremendous tax planning opportunity, because you can reduce your taxes dramatically by taking minority interest distributions with proper planning. And that's something you want to work with your tax people on. Finally, lose interest deductions, depreciation. Yeah, that's true. But once again, anything you buy with a retirement account's not going to give you those things. So really, it's not a statement that holds any water for any reason. Are the investment rules complicated? No, it's very, very simple. When I'm looking at a retirement account, you just think of two things. What do you want to invest in, and who are you transacting between or for the benefit of? That's it. So who you want to buy from, is going to be a problem, because that's a transaction between, disqualified parties potentially. But if you look at what I want to buy, unless it's prohibited, it's therefore allowed. The only things prohibited for an IRA are collectibles, life insurance contracts, or stock and sub S corp. The only restriction when we're talking 401k plan is collectibles. So unless it's prohibited, it's therefore allowed. The menu is literally endless, and we'd be here all day if we're talking about what you can do. So we're going to talk about what you can't do. And once again, with a 401k plan, the only thing you can't buy is collectibles. The things you cannot buy with the IRA are collectibles, life insurance contracts, or stock in a sub S corporation. Typically, the problem is not the investment. Typically, the problem is a transaction between or for the benefit of a disqualified party. And we're going to talk about that in a moment. So this slide 12, just talks about what investments are possible. And literally anything other than collectibles, life insurance contracts, stock in a sub S corporation. And collectibles is the only restriction of 401k. So when we're talking about prohibited transactions, typically we're looking at a situation where there's a prohibited transaction for some action between disqualified parties. Who's a disqualified party to your retirement account? Well, you are, your spouse would be, your lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those. Those are all disqualified parties. So what's interesting is you cannot transact between or for the benefit of disqualified party, but you can transact along with. So remember earlier I talked about a checkbook IRA that maybe had that IRA LLC has multiple members. So we could have even a traditional IRA and a Roth IRA are considered disqualified parties to one another. So you can have both invest in a common investment, and they could invest in that investment either via tenancy in common or via common membership in an LLC. Either way is fine. Each of those has ups and downs. We're going to talk about that in a little while too. But really, what triggers problems is any transaction between or for the benefit of the disqualified party. People ask me, well, hey, little Johnny's going to college. Can I buy a investment house with my retirement account and have my son Johnny in it? And the answer is no, because Johnny's a disqualified party to your retirement account. He's a lineal, descendant there. So ascendants, descendants, their spouses, any legal entity owned a controlling interest by one of those are all disqualified parties. And I'm going to say it one more time. You can transact along with a disqualified party, so you can co-own something, but you cannot buy from, loan to, borrow from, sell to. You cannot use a property. If you buy the place at the beach to retire into, you cannot use that property, period, until it's been taken fully out as a distribution. Examples of prohibited transactions. These are probably the most common situations. So like I said, a Wall Street IRA, you can make a bad investment decision. You're not going to be able to create a prohibited transaction. This is where people typically have problems. Assignment of purchase sale agreement. So you'll think, gee, hey, David said I could go out and buy a piece of property with my retirement account. I'm so excited. I go out there and I write a purchase sale agreement between the seller and myself, and then I'm just going to sign it over. My broker said, hey, the purchase sale agreement is assignable, so we'll just tie it up personally and assign it over to the plan later. That's a prohibited transaction. You cannot do that. So, if you've done that, I would say blow up the deal, just walk away from it, rewrite it. Depending on that structure, if it's a 401k plan, you rewrite the offer between the seller and the 401k plan. If we're talking IRA basic, it's between the seller and that trust company for benefit of your IRA. If it's a checkbook IRA, it's going to be between the seller and your IRA LLC. Any of those things is going to be fine, but we cannot have an assignment of the purchase sale agreement between disqualified parties. That would constitute a prohibited transaction. Recourse debt's another thing. Do not sign for a loan. If you're a guarantor on a loan for your retirement account, that's a prohibited transaction. You cannot do that. What happens if you say, well, gee, I'm going to be a half owner of this property along with my retirement account. I'm just going to be a guarantor on the half that I own. No, you still got the loan because you're signing as a guarantor. So you cannot do that. It's got to be a non-recourse IRA 401k compliant loan in that situation. Another common thing is, remember I talk about that basic account. You've got a trust company that's got an account, and everything's in and out of that trust account. With a checkbook IRA, you've got that bank account in the LLC's name and EIN. With a 401k plan, you've got that situation where you've got a plan, bank account in the plan's name and EIN. Now, with a checkbook IRA, what will happen once in a while is people will think, well, gee, I need more money in the checkbook IRA. So one, these are not all or nothing. So you don't have to, if you've got a bunch of money in Wall Street and you want to use a little bit of it, let's say you want to take 20%, maybe you got $1 million in Wall Street, you want to take 20% of it, go buy some real estate, that's fine. Use that and only take that 200 and move it in the self-directed account because it's isolated from your Wall Street investments by doing that. If you moved all your money into the checkbook IRA and then moved money back to Wall Street, let's say via a trading account in the checkbook IRA's LLC's name and EIN, now the problem is all the money is in that one account. If you commit a prohibited transaction, that account is treated as distributed. So that's a big expense for a potential prohibited transaction, where if you've isolated the money, all the Wall Street stuff, the 800 you left there, only the 200's at risk for the self-directed. So that's two different ways to protect things. It seems like never in life is the easy way, the best way to do it. So people will make a distribution or a contribution directly between themselves and the IRA LLC. Any distribution or contribution has to go through the trust company. So if you want to make an additional contribution to your IRA LLC, you have to make a deposit into the trust company. The trust company then makes an additional investment, your IRA LLC funding the bank account. If you get to a point where you want to start taking distributions, the money goes straight from the LLC through the trust company to you. So either way with that checkbook IRA, it's going to go, there's never going to be a transaction between you, the IRA owner, and that IRA LLC. Never is there going to be a transaction between the two of you directly. Everything has to happen through that trust company. So that's where, that contributions distribution can be problematic. Working on an IRA-owned asset or 401k-owned asset, you cannot work on property that your retirement account owns. That's a prohibited transaction. Sweat equity is not okay. Using the IRA-owned asset anyway, prohibited transaction. Buying from or selling to a disqualified party is a prohibited transaction. Cannot do that. Use of taxpayers' personal insurance policy for the IRA-owned asset. That's a problem. So let's say you've got your home, you've got some other investment properties. Now you take your IRA, you want to go out and buy this other investment property, and you thought, well, gee, I'm just going to add that asset as another insured property. No, you can't do that. You've got to have that insurance policy's got to be in the LLC's name and EIN. And if it's 401k plan, that same thing would apply in that situation. So we've got to be careful with that. And in the bold at the bottom here, generally a prohibited transaction in connection with a traditional IRA account at any time during a year results in basically dissolving the entire IRA as of the first day in the year in which the indiscretion occurred. You don't want to do that. 401k plan is a totally different thing. Only the money involved with the indiscretion is treated as a distribution. So what I tell people is never, ever, ever think of your retirement account as you. People will commonly say, well, David, I own this or I own that via my retirement account. No, you don't. You don't own it. Your retirement account owns it. If there's a tax consequence to something that happened on that property, it's not your tax liability. It's the IRA's tax liability. So if you're flipping properties, even with a Roth IRA, that's not an investment. That's a business. So you're going to be subject to something called unrelated business taxable income. So just be aware of that. And once again, you cannot work on these properties. You can negotiate a purchase on these things. You can manage the property, but you cannot go out and I say get dirty on the property. You can't go pull a hammer out, a paintbrush out, do any of that stuff. Those all constitute prohibited transactions. So how do I do this? How do I create one of these? Now we talked about it earlier. I've mentioned trust companies. And there's probably a dozen major trust companies in the space that have been doing this for a long time. Seems like every few years they change hands and they may change names during that. But if you think about what's going on in that whole establishment stuff in today's world, it's easy for you to go and just stumble upon a web page that for a trust company and start filling out applications. Now, what I'm going to tell you is all trust companies are not created equal. Just like in the 1031 space, all accommodators or intermediaries, facilitators are certainly not the same. You're going to get sort of what you pay for in this space. But when you're looking at a trust company, I really feel strongly with a self-directed account that you do not want to pay a trust company based upon the value of your account. Now, Wall Street, fine, because at any given moment, you've got a stock price or a spot gold price or whatever it might be that tells you exactly what something's worth. But what's a piece of property worth? Or what's a business worth? Or what's a note worth? I mean, a note could be worth face value. It could be worth nothing, depending on what's going on. I had a guy during the last recession, unfortunately, he had $1 million note out of Chicago. The note was bad. He was with a trust company, wanted to charge him based upon that note being worth $1 million. And it was worth zero. So I've had too many experiences, in the 15 plus years of working in this space that I've just had too many times where the trust company is in an adverse position to our investors. I just don't like it. So I encourage people, if they're not going to be working with us on this stuff, to make sure that they understand how that trust company is going to charge. I would say with a self-directed account, you want to be charged based upon the number of investments you've got and the type of investment, maybe not the value of your investments, because there's just too many moving parts. And like I said, what's a piece of property worth? It's always highest best use. So that's one of those things where you can have a big difference in something. And like I said, that previously mentioned note, that was $1 million face value, but it had gone bad. It wasn't worth the paper it was written on. So why was he paying for $1 million valuation when it wasn't worth anything? And he had to prove it up to get the trust company off his back. So just be aware of that. Obviously, one of the reasons people like a checkbook IRA is because of safety. And you might say, well, David, why do you mean safety? What do you mean by that? Well, because your money's not sitting in a bank or trust company that you don't know. Your money is literally in the bank where you've opened that checking account in the LLC's name and EIN. If it's a 401k plan, same situation. The money is where you want it. That's another reason that people like checkbook IRAs or IRA LLCs for gold, let's say, because physical gold, people don't want the money, that gold sitting in some depository across the country they don't know anything about. And if there was some problem, how did they even get the stuff? So with the IRA LLC or checkbook IRA, you just have let's say, a safety deposit box in the LLC's name and EIN, and you put the gold in there. If you go back 15 years ago, maybe you're buying a safe and, buying a safe, putting the safe in your house, put the gold in the safe. Now that is not something you can do anymore. So, forget I said that, but I meant to say it actually, because I want to stress that you cannot do that. So in today's world, you cannot buy a safe, put the safe in your house, buy the gold with your IRA LLC, and put the gold in the safe in your house. That's a prohibited transaction, at least as of the last couple of court decisions. So be aware of that. So check, creating these things can be done online. If you want an IRA LLC, it's a entirely different process. We want to know, we're going to be, in addition to creating the custodial account, we're going to be creating the LLC. We're going to want to know where you live, where you're investing, what state you want the IRA LLC registered in. Registration of the LLC is probably going to be driven by a few different factors. Cost is one of them. I'm sitting here in Southern California right now talking to you. You don't want an LLC in California because you're looking at almost $1,000 annually for that. If you're looking at, let's say, Colorado, it might be 40, I believe. Washington might be 60. Oregon's 100. Different states, different things. You also want to be aware that some states might have foreign or domestic rules for that might favor a domestic entity tax-wise versus a foreign entity. So if you're looking at, I believe Texas is one of those states. If you're buying and investing in Texas, you probably want a Texas entity. The other thing that comes into it is registered agency. You've got to be aware of that because if the LLC is not registered in the state where you live, then you're going to have to pay, for a registered agent. So just be aware of that too. So the checkbook IRA, IRA LLC, this is a bubble chart showing it. So we're going to create the custodial account. We create the IRA specific LLC. The trust company makes the investment in the LLC, funding the bank account. And from that point forward, you're just buying and selling things via that IRA LLC. So it works wonderfully. Once again, selecting trust companies. Some trust companies might not allow you to be the manager of the LLC, which totally defeats the entire purpose. Some trust companies might have a requirement for annual valuations or reviews. But understand what each specific trust company is going to require of you if you have a checkbook IRA, because they're not, once again, all created equal. If you're working with us on it, we have our people that we like to work with. They know us, we know them, and it's not a problem. We get this thing handled quickly. By the way, quickly, what does that mean? Figure quickly in today's world is probably the better part of a month for a checkbook IRA. You might be able to get the account established very quickly, but getting the money moved around can take time. And you just have to be aware of that. But as soon as the IRA LLC is funded, now you've got immediacy of investment as you like. A 401k plan, you've got to initiate the transfer of the funds from the previous employer plan or whatever it might be into the 401k bank account. But that, once again, we can get a solo 401k together in a week's time, so it's much quicker. What takes bulk of the time in either case is just getting the money moved. Solo 401ks, like I said, I love them for people that are self-employed without employees. You can make Roth contributions. We cannot move Roth money or beneficiary IRA into them initially, but the plans do allow internal Roth rollovers. You've got the max annual contribution limit shy of a defined benefit plan. So if you're looking at a SEP IRA or a solo 401k typically might be a little bit more annual contribution than even that SEP IRA. But it's going to give you the most flexibility that way. You don't have tax on leverage. So UBIT, unrelated business income tax, you don't have that with a 401k plan. You do with an IRA. You don't have a custodian, which is wonderful. You can invest in life insurance and S-Corp stock. You just can't buy collectibles. And the other thing that's really nice about the 401k plan, you can borrow half what's in it to a max of $50,000. So that's something you cannot do with an IRA. Rollover business startups. So what we've been talking about so far is creating investment vehicles to make investments. But we might be in a situation where you have the olive branch of your future is actually your retirement account and your ability to go create a business, a livelihood using that. And so what we're going to do in that situation, we're going to create a 401k plan. We're going to create a C Corp. The plan buys the corp buys the business. And now you're working for a business that's owned primarily by your retirement account, or at least partially. We do require our investors to have 5% interest in that personally. That could be cash or in kind. We've had situations where people have equipment they're contributing, different things, and that would add up to their 5% is what we'd like to see in ours. But once again, each company that puts these things together is going to be a little bit different that way. But the Robs can be a wonderful thing, and we've used them, like I said, for everything from mines to real estate investment companies. Doing the real estate deal, okay? So it is easy if you're a broker and somebody comes to you and says, hey, I want to use my retirement account to go buy this property. Your first question is going to be, what type of account do you have? And if their answer is a basic self-directed IRA, you're probably going to run for it. You're going to run for it if you understand, because nothing is going to be easy, because you've got to write, if it's a basic account, once again, the owner of that property ultimately is going to be the trust company, CFPO, your IRA. So if it was mine, for example, it might read ABC Trust Company, CFPO custodian for benefit of David Moore IRA number 32 or whatever it might be, right? And that purchase sale agreement needs to be written between the seller and that account, or some other non-disqualified party. And earnest money, when it's necessary, is going to have to come from some non-disqualified party or from that account. So it can be very cumbersome, where if the investor's answer is a checkbook IRA, now you're just simply writing the offer between the seller and the IRA LLC. Or if it's 401k plan, it's the same situation between the seller and the 401k plan. Or you could add, if you're one of these people that likes a bunch of LLCs, you can always add the LLC, another LLC for either one of them, and that's totally fine. But writing the deal, whether it's the purchase or the sale of the assets, very simple. If it's a checkbook IRA or IRA LLC, you just got a listing agreement between the broker and the investment vehicle. And then when the property is purchased, the earnest money comes from the retirement account. Title goes straight into that retirement account's name. And then when the property's sold, the funds go back into the checkbook IRA, IRA LLC, or the 401k plan just directly. Where if you've got that basic account, once again, you're having to deal with the trust company at every step of the way, which gets very tiresome, especially if you're the broker trying to get through things, contingencies, and just getting money when it needs to be out there for earnest money, or accepting deposits or anything else that might be going on. It just, with that basic account, it might look attractive at the beginning, but as soon as you start working with it, you're really not going to like it if you're dealing with property. Personal and plan money into a common investment. And this would also, just anytime we're taking, let's say, disqualified parties and combining their ownership into a common investment. Really, you've got two different options. You could do it tenancy in common, or you could do it via joint membership in a limited liability company. Now, neither one is perfect. The tenancy in common structure is great, because if you were to be a co-owner of a property with a retirement account and that property goes full cycle, you sell, you personally are going to be subject to taxes on that disposition, hopefully, because hopefully you made some money. The retirement account, if it's unleveraged, funds are just going to go back in the account entirely deferred. If it's a 401k plan, even if it's leveraged investment, the money's just going to go back in the account tax deferred. But there are situations where, if you've got that joint ownership via tenancy in common, when it goes full cycle, you personally could do an exchange or pay the tax. And the retirement account can, if it's an IRA, it can pay the tax, or it can do an exchange too. So there are actually situations where even a Roth IRA might have to do a tax deferred exchange if it's got a leveraged investment. But that TIC structure gives every owner the ability to do what they want to do, where common membership in an LLC takes that away. The entity is going to have a tax consequence on disposition. The entity can do an exchange if it wants to, but that membership interest is problematic. The other thing is, if you're completing a 1031 into a property where you'd like to have co-ownership with a retirement account, that requires tenancy in common. We cannot do a 1031 into a membership interest. These partnership interests are specifically prohibited. The other benefit of the LLC structure is doing assignments. Let's say you want to take an in-kind distribution of the property. So you want to take a series of minority interest distributions to take care of the take advantage of the potential discounting on it. And in that situation, doing assignments, you don't even change title. So title doesn't change. You don't have to have deed changes every time you're doing an assignment of membership interest. And you can literally go from full IRA or 401k ownership via the LLC to full distribution simply by doing assignments of membership interest over a period of time. And that's something you just work with your tax people on, figure out at what point, what structure, how you're going to take those distributions, what's going to minimize your tax exposure on those distributions. But that assignment of membership interest, I really like that option. A few examples, we're done. All right. First one, we've got an investor that is, a tech person actually, and this guy worked for Intel. He always wanted to own a gold, silver, palladium mine. So he was retiring, taking early retirement, and we took his 401k plan and created a rollover business startup for him. So we created a new 401k plan. We created the new corporation. The plan bought the corporation. The corporation bought the mine. And he actually was able to, in his retirement, to go out and run this gold, silver, palladium mine and personally work on it, since it was a rollover business startup and not just a 401k plan or an IRA-owned asset. So by using that structure of the 401k plan and the C corporation, allows him to literally work and be compensated by that company that's owned primarily by his retirement account. So I thought that was really neat, a neat opportunity for him to take advantage of, as something he always had dreamed of doing. Second example, this is a broker that was doing a deal. One of her builder developer clients had run out of money on a project, and he couldn't finish the bathrooms and the kitchen, right? Okay, so how do you sell a property without getting those things done? So she said, look, if you sell me, I'll help you, but I want to make some money on it. So if you sell this property to my retirement account, I'll give you 1/3 of the net profit. So he said, okay, because he was going to be losing the property if he didn't get it done. He couldn't sell it. So basically he did the deal with her. She put the money into the project, got it all finished up. She made $150,000 over a very short period of time, wrote a check back to that previous owner for $50,000, made good on her offer, and took a bad situation for the builder developer, made him whole, and gave herself a nice short-term return for her retirement account. And just, once again, take advantage of opportunities that are there. Invest in what you know. Wall Street world, you're not supposed to do any insider trading. Specific knowledge in anything's a no-no. But in the self-directed world, if you are aware of a situation like this, that's totally fine. And like I said, if you're a real estate broker, hopefully you have some knowledge of real estate that other people don't have. If you're a mortgage broker, you want to do that kind of stuff, great. Maybe you're a gold, silver dealer. Maybe that's what you want to do. Great. You can do that stuff. Next example. In this situation, we're just, going through, and, this guy, basically you start looking at lending and, back to hard money stuff. I mean, a professional lender should, be able to make some good money with their retirement account. I was talking just this morning with my wife about Wall Street and, the roller coaster. I always feel like I'm on it. And the golden rule is never buy or sell on news. And it seems like that's all people do these days. So, think about how often you get up. If you're, like me, unfortunately, I look at there's red or green each morning. This morning it was green, fortunately. It made me a little happier until I couldn't get this presentation started. But, this person just said, hey, I have the ability to make lots of loans using my retirement account at very little risk. I mean, I'm going to underwrite them all, take care of it. And so that's the situation where this guy just said, hey, why wouldn't I do this? Why wouldn't I take advantage of the knowledge I've got and use my retirement account as that source of funds to make these loans and have all the yield off those loans going right back to my retirement account? In this transaction, then example number 4, we just, really, back to my comment on precious metals. We've got some metals dealers. And by the way, everyone, there's no such thing as a gold IRA. It's just an account that's been set up by that broker typically, or that company to buy their stuff. but it's no different than any other self-directed account. So I'm going to say it again. There's no such thing as a gold IRA, okay? It's just a regular IRA account that allows you to buy gold. Any IRA that we put together is going to allow you to do that. Any 401k plan that we put together for you is going to allow you to go do that. So when we're in this situation, he wanted not a basic account because the basic account would have required that physical metal to be deposited into a depository someplace that trust company worked with. And he didn't want that. So basically we put a checkbook IRA together. He opened up a safety deposit box in the IRLC's name, EIN, bought the metal, put the metal in that safety deposit box that was owned by the retirement account. So once again, you're not going to put it in your safety deposit box. It is not yours. Putting it in your safety deposit box would constitute a prohibited transaction. We want to make sure that we're always very, very clear on that. Opportunity number 5, this last one, and this is one, if you've been on my class before, I always give it. Sorry, you're going to suffer through it one more time. But a retired couple came to us, his and her IRAs, wanted to take the money, go out, buy a mobile home RV park. And typically we're going down the road of a checkbook IRA because that's all that's needed in that situation as an investment. As we spoke, we found that they wanted to not only be the managers, but they wanted to be the on-site managers and living there and be compensated for managing that park. Well, none of those things are possible with an IRA LLC or just a solo 401k plan. So we shifted gears entirely away from the IRA LLC checkbook IRA and the 401k plan and did a rollover business startup. We moved his and her IRAs into the 401k plan in the C Corp. C Corp bought the park, and now they got an investment. They got a place to live and a job, all with that one transaction. So that's sort of an extreme example of what is possible with these self-directed accounts if you know what's there. All right. Now, checklist. Plan ahead takes 2 to 4 weeks to establish your self-directed IRA. You can purchase virtually any investment with an IRA, SEP IRA, Roth. You can purchase with family members and friends. You cannot purchase from or for them. Your IRA 401k plan cannot sell to you or any other disqualified party. You can use an IRA 401k plan to buy a property with a mortgage, negotiate from deal's inception, the IRA, IRLC, or 401k plan's name. Don't overextend. Make sure you've got plenty of reserves. Earlier, we talked about a situation where you've got that, see, I was clicking on a frame to get out of it to get back to you. So when we're talking about recourse, non-recourse, you got to make sure that you're always careful on what it is. And this is not anything the retirement account owns is not you. Therefore, you're not going to be a guarantor on it. If there's any taxes owed on that investment, it's not going to be yours. If there's insurance on it, it's not going to be on your homeowner's policy. It's an additional policy in that the checkbook IRA or 401k plan's name and EIN. I always like to say, think of it as Susie down the street. You're not going to take her cash flow. You're not going to work on the property. You're not going to co-sign anything for her. It's literally not you. And when you're coming down with a name on the checkbook IRA, it's often, we encourage people to come up with a name that anytime you look at that name, it's not you. Don't put, if your name is Smith, don't put it Smith's IRA. LLC. Don't say that. Make sure it's something that really means something to you, so that every time you look at that checkbook, anytime you look at that deed or anything to do with it, that is not you. That's your retirement account. Therefore, any of the income off of that multifamily project that is yielded by that investment is the retirement account. It's not yours. The only time you're going to get a benefit of it is through a distribution in the future. So the only dumb question is the one you don't ask. If you've got questions, comments, concerns, please don't hesitate to reach out. There's a glossary at the end of this packet, sort of give you some clarity on some of the terms I might have used. I try to stay away from that shop talk, but hopefully this is worked for you. I apologize, you didn't have the slide deck online. You just got a bigger picture of me. Sorry about that. And once again, David Moore, IRA Advantage. I look forward to working with you. If you need CE for this, you can reach out to C Moore CMOORE at 1031exchange.com. And if you did not get a copy of the slide deck, please don't hesitate to reach out to Seymour at 1031exchange.com. She will get it to you. Thank you so much for visiting with us today. And that is it. I actually got through it despite that late start. So thank you for taking the time. I look forward to speaking with you soon. And all my best to you. David Moore, IRA Advantage, signing off. Bye-bye.